Good morning dear learners, and welcome you all to the module number 7 of my course on financial literacy. This is lecture number 33, Endowment Plans and Pension Policies. In the previous two sessions, we had discussed the various types of investment avenues that an investor may choose for the purpose of investment as well as securing his or her retirement age. In the previous session, we had discussed the various types of insurance products that an investor can choose for securing himself or herself from the various types of risk that may be involved in the business as well as in personal life. We had discussed there that term insurance can very easily give you a life insurance, and with the help of which you can mitigate the risk involved with the early death or any other kind of financial damage to your family members due to any mishappenings to your life. In today's lecture, we'll be going to understand the next part of the life insurance scheme, which is the endowment plan, that gives you a term insurance as well as it also provides you a long-term investment opportunities for investing your fund in a proper manner and giving you some stable and regular return at the old age for the purpose of giving you financial security. Let us know what different kind of topics we'll be discussing under this lecture. So the first thing that we'll be going to understand is the meaning of the endowment policies and the various types of benefits that an investor may have out of an investment into the endowment policies, the various types of endowment policies that are available to us for the investment, pension policies, and the various types of pension plan that an investor may have, and the various benefits that the pension policies have. We'll be also going to understand the concept of ULIP plan and different types of ULIP and its benefit. So let us discuss what do we mean by the endowment policies. Endowment policies is a kind of life insurance policy where you do not only get the life insurance, but you also have an opportunity for investing your money into long-term investment avenues. So it is a type of insurance that provides you a payout either upon the death of the insured or at the maturity of the policy, and it offers insurance coverage as well as the investment benefits to the investor. That means the investor can be assured that at the in the case of his or her death, the financially dependent members on him or her will get sufficient amount of financial resources from the insurance policy, as well as their funds will also be invested into long-term investment avenues, and that will be going to offer some good returns in the coming future. Under the endowment policy, the policy holder, if passes away during the policy term, the nominee receives the sum assured or outlives the policy term. That means in case before the policy term, if the policy holder passes away, then all the financially dependent persons in the family, the beneficiaries or the nominee to whom the policy holder have nominated, they will get the sum assured under the policy with the help of the endowment plans. If the policy holder survives the policy term, in such cases he or she get the maturity benefit, which may be the sum assured plus any bonuses accrued during the policy term. The bonuses here means the return that the investor may have by investing the funds that they pay as premium into the long-term investment avenue by the endowment plan policy schemes. So here in the endowment policy schemes, we do not only get the death or maturity benefit, we also get a benefit of bonus received payment with the help of investment into the long-term security. For example, suppose that if Mr. Ranjan purchases an endowment life insurance policy of rupees 5 lakh, the policy may offer a maturity benefit of 5,50,000 after the total time period of 10 years. Here, the 50,000 rupees is the amount of bonus or excess return that the policy holder will get if his or her fund will be invested into long-term investment avenues for a time period of 10 years. So it provides you a death benefit of 5 lakh as well as a 50,000 bonus for investing your money into the investment avenues of long-term time. So here the Ranjan's nominee, in case of his demise during the policy term, may get a total amount of 5,50,000 rupees if the annual premium of rupees 50,000 is paid by Mr. Ranjan during their lifetime. Suppose that if Mr. Ranjan, he outlives the policy term and he pays a total premium of rupees 5 lakh, in this case also in the 10th year he will receive the maturity benefit of 5,50,000 rupees, resulting in a net profit of 50,000 rupees for Mr. Ranjan. So here in this example we can very easily observe that with the help of the endowment policy, not only you can get an insurance for your life related risk coverage, as well as you will also can have some good returns with the help of the investment of your fund into the long term investment avenues. Now let us understand the various benefits of the endowment policy. It gives you a good investment option, it provides you insurance, as well as some tax saving is also possible with the help of investment into the endowment plans. Under section 80C, you can claim the deductions for investing into the endowment plans policy. So it gives you first insurance benefit. Endowment policy provides you a coverage to the insured family at the time of the death of the insured. The financial damage protection is provided to the family if the person who is a policy holder, due to any mishappening, if his death is there. Then fixed return is there. In endowment policy, return is also fixed either at the time of the death of the policy holder or at the time of the maturity of the policy term. So unlike in the case of the term life insurance policy, where we had discussed the sum assured is received by the nominee of the policy holder only when there is a occurrence of death, this will be not possible here. Here, before the insured is dead, the policy can be again taken by the nominee of the policy holder, or in case of the death of the policy holder, then also the nominee will be beneficiary here. So where sum is received in case of the death of the policy holder only, this will be the case of the term life insurance, which is not there in the case of endowment policies. The endowment policies also offers you certain tax benefits, such as it gives you a tax benefit under section 80C of the Income Tax Act 1961. So to the maximum amount of 1,50,000 rupees per year, you can claim as deductions if you are investing into the endowment policies, as well as if you receive the maturity benefit, that is the sum assured by the endowment policy, then this sum assured is also tax free under section 10 subsection 10D of the Income Tax Act. Again, one more benefit of the endowment policy is there, that is the loan facility. Endowment policy provides you the option of availing loan against the policy. The loan amount is the percentage of the policy holder's surrender value, and the interest rate is the usually lower as compared to the other lower option, because here as a mortgage you are providing your life insurance policy to the bank or the other authorities for the purpose of taking financial loan. So here are some characteristics of the endowment plans. It is a low risk investments. Here you are getting an insurance for yourself, so it is lower risky investment since it also invests your fund into the long term investment. Flexibility in cover, it provides you flexibility in cover, as there may be the payment of the sum assured at the time of the death of the policy holder as well as at the time of the maturity also. Flexible premium payments are also designed into the endowment policy plans for the policy holders and their convenience of paying the premium to the insurance companies. The death along with the survival benefits are also provided into the endowment plans, and tax benefits are also available in case of the endowment policies. So these are the various characteristics of the endowment plans. Now let us see the various types of endowment policy plans. What are the various types of endowment policies? There are pure endowment policies such as survival based benefit, no death benefit, refund of premium, focus on saving, and suitable for people who are looking for financial planning tool tied to a specific time frame. For example, if they are planning their retirement or their children's education. So the first one is the pure endowment policy. Basically, the pure endowment policy is a kind of insurance policy that pays the sum assured only if the insured survives the policy term. So survival based benefits are given here in case of the pure endowment policy. No death benefit is given to the nominee. That means if the insured dies during the policy term, no payout is made to the nominee of the policy holder. If there are some specific terms and conditions in the policy, then there may be some cases where such kind of payments can be done. Refunds of payments can be, premium can be done. Some policy may offer the return of premium on the death of the policy holder, but this may depend on the terms and condition of the policy, and it focuses on the savings. So it is a saving instrument rather than a protection plan, and it may be ideally suitable for those individuals who want to accumulate the wealth for their future needs. Now the next part of the endowment policy types is the ordinary endowment policy. Basically, ordinary endowment policies is the classic form of the endowment insurance that combines both insurance coverage as well as the investment benefit for the policy holder. Here the death benefit is given to the policy holder. If the insured dies during the policy term, the sum assured is paid to the beneficiary. Survival benefits are also there. That means if the insured survives the policy term, the sum assured is paid to the policy holder. So dual benefits are there. Sometimes it may gives you some benefits of the term insurance, that is the protection, and pure endowment benefits also, such as savings. Next feature of the ordinary endowment policy is the wealth accumulation. That means it is suitable for all the policy holders who aim at accumulating the wealth. That means who want both the insurance coverage as well as they need a lump sum saving of the money at the end of the policy term. As well as it also provides you an option of the bonus. That means there is bonus eligibility in case of the endowment policy. Often eligible or reversionary bonus are given to the endowment policy holders in case of an ordinary endowment policy on the basis of the long term investments made out of their total premium paid during the term of the policy. Next policy under the endowment policy is joint life endowment policy. This kind of policy covers more than one person under a single contract. That means the policy holder may join some other person also in such kind of the contract. The sum assured is payable either upon the death of the first insured person or at the end of the policy term, whichever occurs the first. So in the joint life insurance policies, here the insurance coverage will be provided to more than one person. So this is known as the joint life endowment policy. Then there is double endowment policy. In such kind of endowment policy, if the insured dies during the policy term, the basic sum is assured is paid to the beneficiary of the policy holder. However, if the insured survives the entire term, double the sum is paid to the policy holder. That is why it is known as the double endowment policies. Now, the next section of the lecture is focused on the pension policy. So here we will be going to understand for the retirement planning when we will not be able to work efficiently and earn a livelihood for ourselves, what different kind of financial plans we must make at present for the purpose of having a regular and constant earning at the age when we will not be able to work. So pension policy is basically a kind of policy that provides you a protection against the age of retirement when you will not be capable of earning sufficient revenue or income from working. In such case, a pension policy is purchased by those individuals who want to secure financial stability in their life after the retirement age. It ensures that they must have some regular source of income in the old age, so that to reduce the need of depending on the others for the purpose of their financial expenditure. A pension plan is where you will be going to deposit a part of your present income in a specific type of retirement plan during your active life. That means when you are working, and it will ensure that you have a regular source of guaranteed income when you will retire in the future. So basically, pension plans gives you an opportunity to save at present enough amount of money so as to have a regular earning at the age when you will not be able to work. The various types of pension plans are deferred annuity, immediate annuity, life annuity, pension plans with life cover. Deferred annuity basically is a case where you need to deposit a sum of money periodically over a period of time, and after that you will receive the periodic payment of that money in the form of annuity or pension from the deferred annuity policy. So in such case, you may deposit an equal amount of the fund, such as say 20,000 or 30,000 per month into the scheme, and when you will retire after the age of your retirement, then you will be going to get the sum in the form of periodic return or payment into the deferred annuity plans. Then comes the immediate annuity. In the immediate annuity plans, you can invest a lump sum money and you will receive the immediately annuity amount from the policies. So this plan is suitable if you have just retired and you have got a lump sum amount with you after the retirement age. You can invest it into the immediate annuity schemes and you can get a regular income with the help of the annuity schemes in the case of the immediate annuity. Then comes the life annuity. In this plan, a predetermined amount from the policy holder throughout his or her life is paid after the age of retirement. Then comes the pension plan with life cover. A pension plan with life cover offers you the dual benefit of saving as well as financial security for your loved one in case of any unfortunate event. So these are the various types of the pension plans. Now let us discuss the various benefits of the pension policies, how you can invest your money into the pension plan, and what are the different advantages you may have of investing into the pension policy. You need to understand this, then only you will be able to justify your savings into the payment of the pension plans. So the basic benefits that you get from the pension policies are protection after retirement. That means at the age when you will not be able to work, it will give you a financial security as well as it will give you regular income in the form of annuity payments that will help you to manage your daily and regular expenditure. It encourages the savings. That means the habit of saving some amount for your retirement age may be encouraged with the help of the pension policy plan. So it is a great way to save money effectively. For the savings, you need to have a disciplined and periodic contribution into some fund for the purpose of getting some regular as well as constant return after the age of retirement. So it will help you to develop a consistent saving habit and to save your amount into the pension plans. It also offers you some tax benefits. So tax deduction of up to 1,50,000 under section 80C is allowed under the Income Tax Act 96, as well as for the pension policy under section 80CCC and 80CCD, you can get some claims and deduction deduction of rupees 1.5 lakh rupees for the purpose of investment into the pension policy plan. So this helps to reduce your tax liability, as well as it also improves your habit of saving into the retirement plans. It also helps you to offset the inflation. That means some pension plans are specifically designed to help to offset the effects of inflation by offering increasing annuity payouts over a time by investing your money into the long term investment plan. For example, the ICICI Pru guaranteed pension plan flexi is there, in which you can invest and you can have higher annuity payments after your retirement age for the management of your financial expenditure. Now, the next part of the discussion is the unit linked insurance plan. So, we have discussed about the endowment policies, term insurance, pension plans, and now we are going to understand the unit linked insurance plans. All these different types of financial products provides you an opportunity to protect your future financially, as well as also provide you a source of income at the age when you will not be able to work, or in case of any mishappenings to your life. ULIP plan is basically a kind of financial product that provides you insurance coverage, as well as it also offers you some benefits of investment. That means under this plan, the whole amount of investment in the form of premium by the policy holder is divided into two different parts. One is invested into the long term investment market, and one is kept for the purpose of meeting the insurance coverage needs of the policy holder. So, the premium paid is allocated towards investment in mutual fund such as debt, equity, or mix of both for providing long-term benefits to the policy holder. In the event of the unforeseen situation, the plan offers insurance protection also, and while during the policy term, your premium continues to be invested into the financial market. So, various types of mix of the financial avenues are taken up for the purpose of investing your money. The first ULIP in India was introduced by the Unit Trust of India in the year 1971, and then by Life Insurance Corporation of India in the year 1989, for giving the various investors into the market both life insurance coverage as well as investment avenue. Now, what is ULIP? Let us understand. Basically, it is a financial product that provides you life coverage. It is a product that also offers you some investment benefits, as well as it helps you to minimize your tax burden. So, it may have three different advantages for you. You can have insurance coverage for your life related risk. You can get the benefits of long term investment, and you can save your tax burden also with the help of unit linked insurance plan. How it works? The premium amount is divided into two different parts. One part of the premium is kept exclusively for buying the life insurance cover, while the remaining part is used for the investment purposes. Who can seek the ULIP plans for the purpose of investment? So, anybody who meets the criteria for minimum or maximum age as per the rules of the policy. So, the rules may be laid down by the insurance company, and according to the rules of IRDA, accordingly if they make you eligible and your age is in the limits as said into the rules of the policy, you can take the help of the ULIP plans. And anybody who can make the premium payments on time as per the rules and regulation. So, what advantages you may have? You may have long term wealth creation with the help of ULIP plans, as well as you can also increase your exposure to the money market and other financial market segments. Now, let us see how the unit linked insurance plan works. In such case of the unit linked insurance plans, the policy holder first pays the premium either monthly, quarterly, or annually as it suits to them. So, they can opt the form of payment in which form they want to make the payments of the premium. Then the overall premium is split into two different parts for the purpose of providing life insurance cover to the policy holder and for investing into the funds of their choice. That means equity, debt or hybrid, whatever form you want to invest your money in those different funds, the insurance company invest your fund. Units are allotted in proportion to the fund's NAV, that is the net asset value, and the returns are depend on the market performance of the selected funds. The policyholder can switch between the funds, that means they can switch between the equity fund or debt fund depending on the type of risk they want to bear for the purpose of investment. If they want to bear high risk, then they can take the equity investment, or if they want a lower or moderate type of risk in their investment, they can switch to the debt fund in the ULIP plans during the policy term. So these are the various methodology with the help of which the ULIP linked insurance plans invest your money into the financial market for giving you both the benefits of the insurance coverage as well as the investment benefits. Now, the ULIP plan also have a certain lock-in period. So let us understand what do we mean by the lock-in period in ULIP. So basically the ULIP insurance plans comes with a lock-in period of 5 years. That means being a combination of the insurance coverage schemes and providing you the benefits of the long-term investment, this kind of the plans should be held at least minimum for 5 years or more for the purpose of locking your fund into the scheme. So in the unit linked insurance plans, you will always find out that there is a time period of 5 years that is kept as lock-in period for keeping your fund locked into the investment. So a unit linked insurance plan is a financial product that combines both the life insurance and investment opportunities, offering you both the protection and the potential for wealth growth, and it works by allocating the total amount of premium into two different portions, one for the investment and one for the purpose of providing you insurance coverage, and it also holds your total money for a limited lock-in period, say 5 years, for the purpose of keeping your funds invested into the market segments like money market and financial market segment. So market linked funds like equity or debt or balance fund are taken into consideration for the purpose of investing your fund into the market. Then different type of ULIP plans are there, such as equity based ULIP plans are there, debt based plans are there, balanced funds are there, and the various types of the ULIP plans that we are going to discuss here are designed on the basis of risk that a policy holder wants to take. So equity based unit linked plans are basically the investment here is made only in equity security. So it is basically suitable to those policy holder who want to take higher risk and want to earn higher income, that is higher return from their investment. So this case of the unit linked insurance plan, the investment is specifically made in equity securities in the market. Then comes the debt fund. This kind of ULIP plans invest the premiums taken by the policy holder into the debt instrument of the financial market. That means in the money market segment, they can get the government securities, bonds, debenture and other similar assets that can provide you a constant and regular return. So the risk exposure in such case of the investment avenues will be also low and moderate. So those investors who do not want to be a high risk, they can take the help of the debt fund. Then after that there is a balance fund. Balance fund, as the name suggests, is a combination of equity and debt based by ULIP plans. So where investments are made both in the equities and the debt instruments in the financial market. So it is a kind of hybrid type of investment where both the risk related management of the policy holders amount is done by diversifying your investment into the equity and debt securities in the market. Now let us see the various benefits of the investment in unit linked insurance plans. With the help of investing your money into the unit linked insurance plan, you can fulfill your long term financial objective. So it aims at long term goals. That means it is considered as a best option for the investment when you have any long term financial objectives with you, such as planning your child's education, retirement planning, or building a home. Since the cost associated with ULIPs can be relatively high, they are not suitable for the short term investment. So if you want to invest your money for a shorter period of time, you should avoid the unit linked insurance plans. However, long term objectives such as buying a house or expanding your business organization, you can take the help of the ULIP plans. Tax advantage is also there. So one of the very important benefit of the ULIP plan is there, that is the section 80C of the Income Tax Act, and subsection 10D is there that provides you certain tax benefit with the help of which you can minimize your overall tax burden if you take the unit linked insurance plan as an investment option. Then comes, it is a good investment option. So if you do not just want to invest your money into the money market or in other financial market segment, and you also want some insurance coverage, then this can be a very good option for the investment of your money. So not just insurance plans, they will also offer you the opportunity to earn market linked return, combining both the protection with the wealth creation objective. Then it also provides you flexibility by allowing you to switch between different investment options, such as from equity to debt, based on your risk appetite and market conditions. So you can switch into the equity plans or hybrid plans as it suits to your need in the different time zone. Now let us have comparative analysis of all the products that we have discussed till now. So we have discussed about ULIP plans. In the previous session we had discussed about mutual fund, and in the previous lecture we had discussed about the term insurance. So we know all the characteristics, benefits and other specifications related with all these different kind of plans of investment that are available to us. So let us discuss the comparative differences between all these three types of products that are available to us. So on the basis of the features, if we discuss the different point of differentiation, then in case of ULIP, it provides insurance coverage, and term insurance also provide you insurance coverage, whereas if you invest your money into the mutual fund, it will not be going to provide you any insurance coverage. If we talk about the investment return, then in ULIP, market linked investment return is there for the investor. Similarly, the mutual fund also provides you market linked returns, whereas in term insurance you will get no return, you will only get insurance coverage. In the event of your death, your nominees can get a financial damage cover by the term insurance policy. If we talk about lock-in period, in case of ULIP, there is 5 years lock-in period. Minimum you need to invest your money into a ULIP plan for 5 years. In case of the mutual fund, only ELSS scheme, equity linked security schemes, have a lock-in period of 3 years. Otherwise, the other mutual fund schemes do not have any minimum lock-in period. In case of term insurance also, there is no lock-in period. If we talk about the flexibility, ULIP plans is moderate on providing the flexibility of choice of investment to the policy holder. In mutual fund, high flexibility is provided to the investor by giving them a portfolio diversification of their fund. Whereas in case of term insurance, no flexibility is there, as there is no benefit or investment return in case if the policy holder outlives the policy term. If we talk about the charges, in case of ULIP, the charges are high. In case of mutual fund, the charges are low to moderate, and in case of term insurance, the charges are low. So the insurance companies or the mutual fund companies, those who charge you for providing you these financial products, they may charge high for ULIP, low to moderate in case of mutual fund and low in case of term insurance. If we talk about the tax benefit, there is a tax benefit under section 80C and 10D in case of ULIP. For ELSS scheme, 80C is available in mutual fund option, and for term insurance also you can get a deduction of 1,50,000 under section 80C. So this is a comparative analysis. According to your financial objective, you can choose any one of three for the purpose of getting an insurance coverage as well as an investment avenue for investing your money into the financial market. Now next, let us understand who should consider the ULIP for an investment avenue. As an investor, if you want to invest your money into long-term investment plan that also must provide you some insurance coverage, that means an investment combo of both the long term investment plan as well as insurance must be there for all those investors, it may be a good option. After that, those individual who wants to take a low to moderate risk for the purpose of investment, for them also ULIP plans are a beneficial option. Then people who are having tax saving goal, who want to minimize their tax burden, they can opt ULIP, and it is also ideal for the long term objectives of any investor, such as if you want to have a wealth accumulation for your children's higher education, you want to create a retirement corpus for planning your retirement, or wealth creation over 10 to 15 years for any personal purpose, you can take the help of the ULIP plan. So with this discussion, I hope now you must be having a clear idea that if you want to invest your money into the financial market, as well as if you want to have some insurance coverage also, then these different options may be beneficial for you, and with the help of the comparative analysis also, you can choose the one plan that may be suitable for you. With this, we come to an end of this lecture. Thank you.